Consumer debt hits record $16.9 trillion high as delinquencies are on the rise. And it really only makes sense that at the same time, Ford is releasing or moving forward with patent applications for the automaker to have the ability to repossess cars remotely. Crazy stuff, crazy time, folks, at a time where people are telling me that they don't even have any money. Meanwhile, many others are asking, how can I improve my financial situation and turn this ship around? Can you teach me more about investing for beginners? And with that being said, low index funds as a side hustle. Big shout out to Bupe in Africa, in Zambia, Africa, who shared this information with me to share with you all about investing for as low as $100 with low index funds. Now, we're going to touch on that in just a moment. But as we can see here, household debt sees largest increase in 20 years, folks. Let's see what they have to say about this.
Thanks, Judy. The New York Fed in its fourth quarter household debt and credit report reporting that debt surged by $394 billion in the fourth quarter. That is the largest increase in 2 decades. Breaking it down, mortgages up a strong $254 billion. Credit cards up $61 billion, the largest quarterly increase in the history of the survey, going back to 1999. Auto loans up and student loans as well. Now,
I'm not surprised that mortgage debt is up, obviously, based on what we saw as far as the appreciation and the rapid increase in home value prices, real estate closing amounts. There was a period of time where people were just losing their minds, going crazy, spending over asking, oftentimes being all cash. But what you guys need to understand and realize is that a lot of these, especially if you missed out, especially if you got beat out by another offer because they were all cash, more than likely they used their cash to put them in a position to be the strongest buyer, to make their offer look the best. Then they would finance and put a mortgage on the property at these ridiculously low interest rates and then pull their cash back out. Okay, so this is a management of funds and money and a way to conduct business to put yourself in the best position possible to get exactly what you want. Credit cards is disturbing because credit cards, having an increase in credit card debt on the rise just means that people can't pay for things like they should. There's really no reason you want to carry a credit card balance. And the only reason that you would is because you either A, don't have the money to cover it, or 2, maybe you're in an introductory credit card promotional term, which will allow you 3, 6, 9, maybe even 12 months, same as cash, no interest, not accruing interest. But that would be the only time that would make sense to carry a balance on a credit card. Auto loans on the rise. And again, like I said, Ford has been working on the technology to repossess cars remotely, and they've actually been working on this for several years. But now they're actually moving forward with the patents. I would expect to see this rolling out here relatively soon, especially with the advancements of autonomous self-driving technology, OpenAI, ChatGPT. This is the beginning of the end, folks.
Delinquencies, they did tick up for credit cards, auto loans, and mortgages, but the rate or the level remains at or below the pre-pandemic level. The trouble is the transition into them. There have been some worrying increases into the transition of delinquency rates. So a blog by the New York Fed, the company this report says, credit card borrowers are missing their payments and transitioning to 90-plus day delinquency at a rate higher than they had before the pandemic got.
Yeah, so if you're, again, carrying a balance on a credit card is terrible, but if you're now in a delinquency period and you're 90 plus days past due, this is literally just a telling sign of the state of the economy that we are in right now. And for so many folks out there who haven't had the opportunity to take their finances from being kind of like down here at a point where they're falling behind and getting hit with these delinquencies and possible charge-offs, bad debt, bankruptcy, repossessions of these automobiles, eviction, foreclosure. This is growing. This bubble is growing. Like, as he said, the transition into it, we are seeing it more so now because we're coming out of this free money from the Fed, this printed money from the stimulus checks and things like that they were sending out to people, all these high levels of unemployment, paying people to sit at home and not go to work. And, you know, the the cows have come home to roost, you know? So basically, we are seeing all that build up. Now the party's over. The music is fading. This game of musical chairs, like I told you guys before, is almost over. And when the music stops, there's going to be far more people standing around than there are chairs, ultimately losers of this game. And the next game won't be starting up anytime soon. So I think it's very important. I think it's of huge importance and urgency that folks really take control of their finances now while you still can before things get really, really bad. With that being said, I got a bunch of free links down below in the description if you want to check them out, of ways for you to do just that.
All we can do is watch this. We don't know how much stress there is, but certainly there is some increasing reliance by households on debt. Plus you have the higher interest rates, and that's part of the reason why mortgage total balances may be going up.
Steve, might we be boiling?
No, he's absolutely right. The higher interest rates now on top of the higher price real estate, which real estate's still selling, by the way. I mean, it's an incredible market to be in. I know a lot of real estate agents that are doing tremendous right now. And with the higher interest rates, that will drive up the debt on the mortgages.
Consumer frog here. I mean, with inflation ahead of expectations, right? Stuff is still kind of expensive out there. And then with the credit card usage being higher and the interest rates are higher, and the Fed, you know, people are saying, I heard you this morning, that the Fed is going to have to keep raising for a longer period of time.
Yeah.
I mean,
Nah, yo, I got to tell you guys, prices are high. I ran out this morning to grab some quick breakfast because I was starving. Maybe you guys might hear the story on Squirrel Tribe 2.0 about what happened to me yesterday. But at the end of the day, by the time I got up this morning, I was literally about to eat like this laptop. Just take a bite out of this joker. I was so hungry. But I ran over to McDonald's, and I was shocked at how much McDonald's costs now. McDonald's, a hash brown was like $2.50 for one hash brown. It's $2.50. I remember when McDonald's had a $1 menu or 99-cent menu, and a hash brown was $2 something. And you know, it's crazy how expensive this stuff is. But at the same time, I did put it on a credit card. So you know, there is that. The difference is this credit card gets paid every month, and I don't carry a balance. So, but yeah, I mean, this is more so for protection. This is a safety measure. You guys know how I feel about using my cash, and I hope my credit card number's not on here showing you guys. Y'all go on a shopping spree. But yeah, you guys know how I feel about using my cash, and this is just another form of diversity and security, folks, as well as cash flow. So you guys are aware, if you've watched my channel before, you know my 3 pillars. But at the same time, using a credit card allows me the diversity that I need. It provides me the security that I want. And it also provides me with cash flow because that particular card actually provides me with the rewards, cashback rewards, which is really, really cool. And they don't send me a 1099 for the cashback.
and that's a vice that's tightening later in the year, isn't it?
John, I want to reject your metaphor of comparing the consumer to a frog, but I can accept your premise that is certainly something that's happening out there. I think the idea, you do have strong job growth, you've had strong wage growth, and so there is scope for consumers to bring on additional credit. You also have this idea that if people believe inflation is temporary, they could use credit to what they call smooth out their spending and their lifestyle over time.
That's a good question. Comment down below and let me know if you think that this inflation is temporary, or if you think this is going to continue on for months, even years to come.
it gets into trouble if people lose their jobs, lose their ability to pay those balances.
Yeah, because if that were to happen, we would end up in that no landing scenario that I discussed with you guys on a previous video. But with the potential for job loss on top of 90+ day delinquencies on credit cards, and automakers looking to automatically repossess vehicles, which actually, I don't know if you guys have heard this story before, but what Ford has been looking to build out in their tech. Because you got to realize these vehicles are becoming more of a computer on wheels than anything else. And the techniques, if you guys want me to go into it, drop a comment, let me know. But the tactics that they're going to they're discussing implementing in the process of getting you to pay your delinquent and overdue and past due balances on your cars before repossessing them or having the cars just drive back to the dealerships or to the salvage yards to be just destroyed. It's pretty intriguing, folks, to say the least. And these companies are forward thinking in how they are going to recoup their collateral, the best of their abilities to gain access to having these assets back when folks don't pay, okay?
Well, that's where you get into trouble. Your delinquencies have really not become worrisome or recessionary levels yet. The thing to watch, the way I compare it, John, is think about a lake, which, okay, the water level of the lake is below where it was the pandemic. That's the total debt level. The flow into the lake is higher than it was before. So we have to watch this 90+ delinquency transition rate. And the New York Fed in the blog, John, pointing out that it's especially difficult or high among younger borrowers.
And folks, if you guys are in that bucket of the flow into the lake of the delinquencies and you need some assistance, you need someone to talk to, feel free, reach out. My contact information is down below. So we can see here that mortgages, credit cards, auto loans, and student loans, the debt is on the rise, folks. This is alarming to say the least, and should be, motivation for anyone out there who is potentially adding to these figures here to make something happen and make that change before you find yourself in a really bad situation. Credit card balances grew robustly in the fourth quarter. And I mean, that's just not a good sign. It's not a good sign unless you're using your credit card to say, for instance, for business. I could see using a credit card for business and the balance is growing, but that just means that my business is becoming even more profitable, producing more revenues from the balances that I am creating and charging. And as each month goes by, the balances continuously get higher. I continuously pay them off, and I keep using this in a cycle to continuously make money. And I know a lot of people who are actually doing this in a variety of ways, and one of them is actually with cell phone flipping. So if you guys want to know more about that, let me know. And it says that the explosion in consumer debt came amid an ongoing increase in federal government borrowing. Total U.S. government debt now stands near $31.5 trillion, up from $29.6 trillion at the end of 2022. That's a massive increase, according to the Treasury Department of data. So, I would never run my balance sheet like the Fed, the government. But I can't, because I can't just print money, or at least not like they do. But Bupe, she sent me a lot of information I want to share with you guys, and hopefully this is going to be very helpful and beneficial to those out there looking for information on how to invest for beginners. And, invest for as low as $100 with low index funds. And I'm glad she shared this, because there's a lot that I want to discuss with you about this. And it says that low index funds are a pooled investment with low expense ratio or management fees, okay? And the low index funds can be invested in at any time, especially for long-term investors. But for short-term investors, it is best to invest during a market rally. So, folks, you may have seen my previous video where I discussed investing, and really it's pretty simple for me. And what I do is, if the market's red, I'm buying, plain and simple. So low index funds is the best for you if you have low capital because it has low fees, tax advantages, and low risk, which ties into a lot of the questions that I get asked most often, which is how do you invest with very little money? Or even better yet, how do you invest with no money? Which I actually made a video that answers that specifically of how to invest with no money. Go check it out if you want to see. And it says that you can use brokerage firms like Vanguard, Fidelity, eToro to buy or sell your index funds. And with that being said, Moo, link in the description, get your free stocks. That's free money. You want to know how to invest with no money? Get free stocks. Done. And all you need is to open a brokerage account, choose between mutual funds or ETFs, pick your favorite fund, enter the trade, and voila, you are an index owner. And it says that low index funds are affordable because they are passively managed, which means that they do not require active trading or in-house stock analysis, which, again, common question, passive income. How do I generate passive income? Folks, it's literally right here in front of you. I'm going to show you in just a moment that low index funds generally outperform other mutual funds. So if you're in a better hands, and so is your investment for the most part. And the Motley Fool, which Bupe provided a link to, shows the 10 best low cost index funds. So check it out. Check out the top low cost index funds and see if any are a fit for your portfolio. And it says here that low-cost index funds are pooled investments with low expense ratios or annual management fees, and investors who focus on minimizing their investing costs can generate vastly superior returns over time since money lost to fees is no longer compounding in your investment account, okay? So let me break that down. Last video I posted, or second last video I posted, somebody said, can you break this down into layman's terms? Well, here you go. An ETF's expense ratio indicates how much of your investment in a fund will be deducted annually as fees. A fund's expense ratio equals the fund's operating expense divided by the average assets of the fund. A good guiding principle is to not invest in any fund with an expense ratio higher than 1%. So basically, we want to make money, but we don't want to spend a lot of money to make that money. And you will be spending that money through higher percentages on expense ratios. And it says that many investors prefer to invest in index funds, which are a type of exchange-traded fund or an ETF, over mutual funds because of their low expense ratios and tax-efficient nature. And index tracking ETFs typically have low expense ratios because they are passively managed, which keeps operating expenses low. Passive income strategies don't require any in-house stock analysis or active trading. So set it and forget it, basically, folks, which is super easy, super simple. Choosing a low-cost index fund fits into a few different categories. Understanding these different types can help you choose the best low-cost index fund, okay? Now, we've got the total U.S. stock market fund. Investing in total U.S. stock market funds, which track indexes that include all publicly traded U.S. companies, is a solid choice, according to the Motley Fool, for ultra minimalist investors who want broad-based exposure to the U.S. stock market. Simple as that, easy. S&P 500 index funds are funds that track the S&P 500 and offer one of the simplest ways to gain diversified exposure to the largest U.S. companies, while index funds by market segment is investing in ETFs by market segment, providing another way to structure your low-cost index fund portfolio. And investing in index fund focused on large cap, mid cap, or small cap companies can help you tailor your portfolio in accordance with your risk appetite, okay? Now, they've got a list here, folks. They've got a list. They got Vanguard S&P 500, Vanguard large cap ETF, Schwab US large cap ETF, Vanguard mid cap ETF, Schwab US mid cap ETF, folks. And you can see the expense ratios here are all under 1%, but many of them are under less than 0.5%, okay? So low cost expense ratios so we can make more money and keep more money, more importantly. And if you want to hold a single index fund ETF that invests in the total U.S. stock market in the right proportions, then according to Motley Fool, the Vanguard Total Stock Market Index Fund ETF is your best option. Holding shares in this fund makes owning other stocks or ETFs redundant unless you want to concentrate your portfolio's exposure in a particular segment of the market. And by holding shares in this fund, you'll hold large, mid, and small cap companies proportional to the broader market and at a bargain basement expense ratio. But you gotta love that. And for the set it and forget it investors, this strategy is very difficult to match from a time and cost efficiency perspective. Many fund management companies offer total market funds at similarly low costs. And if you're new to investing and you don't know where to start, well, folks, feel free. Like I said, links in the description down below. Contact me. I'm sharing this information on a regular basis with the folks in the network on patreon.com/@Kevin247. And it says here that the Vanguard S&P 500 ETF tracks the S&P 500, the benchmark index weighted by market capitalization that includes 500 of the largest U.S. companies. The broad diversification of this fund is appealing to many investors, I being one of them. And the S&P 500 is self-cleansing, meaning that when a particular company no longer qualifies for inclusion in the index, it is removed and replaced by a growing company that deserves to be included. The formulaic nature of this inclusion process ensures that only high-quality companies are listed by the S&P and invested in by the Vanguard S&P 500 ETF. And this is part of my long-term growth strategy: buy, hold, never sell. Buy when it's red, buy when it's down. The Vanguard Midcap ETF invests in companies with mid-range market values, typically between $2 billion and $10 billion. The midcap market segment includes companies with established businesses and reliable revenue streams, many of which have yet to grow into their full potential. The ETF tracks the CRSP US Midcap Index by aiming to hold the same stocks as the index and in the same proportion. The fund's small expense ratio of 0.04% is competitive among midcap ETFs, folks. Now, we can go through all of these and so much more, and I'm just going to show you guys that there is tons more available on the Patreon for the members in the network, and just letting you guys know that there's way more that we can get into as far as building businesses, building wealth, diversifying your portfolios, securing your assets, and continuously building cash flow streams. That's going to be very, very important here moving forward. And folks, don't forget, Hard Assets Alliance is in the link down below. Get started now, folks. What are you waiting for? Look, we've got a lot to cover. We've got a lot that we need to go over. We got a lot of headlines here. We got a lot more breaking news coming out each and every day about the state of the economy and the possibility of this looming recession as we're on the brink of a recession. And I know that there's a lot of people out there who are looking for ways to not only secure what they have, their savings, their nest eggs, and their retirement plans, but they're also looking to build these out even further, add diversity to them, multiply their income streams, develop passive income streams. And there's a large portion out there who have none of that whatsoever. They have no money, zero prospects, and they're looking to get started as a beginner. And folks, you've come to the right place. If you want to know what's going on, if you want the best possible chance at preparing, building out your plan, and most importantly, having access to the truth, well, folks, my name is Kevin in all caps, youtube.com/@Kevin247 or even Kevin Prepper. I appreciate you guys watching. I'll see you on the next one. Take care. Bye.